Okay, Mike here. I want to do a video about Target. I actually did 2 Facebook posts about it and did a blog post on my own website about it because it's so crazy and is an example of the nuttiness that the U.S. stock market has become. Here's shares of Target right here. The stock crashed today. It's down over 9%. Look, I like shopping at Target, but I think some really weird things have been going on with the stock that we need to learn from. First of all, Target stock was in a slow decline since it peaked in July 2015. It fell from $82 to $66 and then had a massive rally. And it's this rally that I want to show you why it happened because now the stock's crashed. So why did the stock go up and then crash? Well, the crash is taking place today because the company announced horrible earnings. In its earnings report, it gapped down, but then it also said that it's expecting a poor outlook for retail sales for all retailers. There's no economic recovery. The word they used was belt tightening is going on. So that's why the stock's down, and of course it fell slowly into this news. It's not really a shocker. Other retail stocks have been making other announcements of similar types. In fact, lots of companies have had poor earnings reports. Disney just did it a few weeks ago. Apple, of course, did it recently, and so forth. Here's the thing, though, about Target. Why did the stock have this incredible rebound if the news was bad? And that's what we're going to break down. Of course, the stock market did have a rebound too in February and March after declining sharply in January, but it didn't go up like Target did. So I'm sure a little bit of that helped, but there's something specific to Target. And let's look at it and break it down. If you go to Yahoo Finance, of course, here's the news stories about people in shock. A lot of bag holders are getting hurt today. There's no doubt about it. But something interesting has happened. If we look at Target's balance sheet, there's something very interesting that's taken place over the past couple of years. The company has bought back shares. It bought back $1 billion. It spent $1 billion of its own money buying back shares in 2014. $1 billion of share buybacks. What that means is there's shares outstanding that trade in the stock market. It bought back those shares, reduced the float out there, reduced the shares outstanding. Now, in 2014, it made $1.9 billion in net income and spent $1 billion of that money on buybacks and so forth. It helped create a negative cash flow because it also paid back dividends to people. Now in 2015, though, it reduced those buybacks, so there wasn't such a big impact on its balance sheet. But here's what's remarkable. This year, Target bought back a whopping $3 billion worth of stock in the first quarter, in 3 months period. That's absolutely incredible. A $3 billion in 3 months, and it's a huge amount of money spent on buybacks. Now remember, buybacks take shares off of the market, so that helps stabilize the stock decline and help make the stock eventually go up, because Target itself is buying back shares, or was, so it helped create the rebound itself. And now, of course, the stock's crashed. Why would the company do that? Why would the company buy back shares, help make the stock go up? Well, here's where things get really disturbing. If you look at the insider transactions for Target, you'll see that over the past 6 months, insiders, corporate CEOs, people on the board of directors, and so forth, have actually sold 15.5% of their own holdings. And here are the transactions. In March, we can see that Officer John Mulligan sold almost $3 million worth of shares himself. Timothy Bayer sold 1 million shares on March 16th, and then he sold another 23,000 shares stock transaction for another $1.9 million on March 16th. Robert Hairston, he sold $67,000 worth of stock. O'Brien Cornell, he sold $2 million worth of stock. Here's Laisha Ward. She sold, I guess it's a she, $4 million. And remember, all these stock transactions are taking place in March. So Target CEOs, management decided to buy back $3 billion worth of stock to help make the stock go up, while they themselves sold millions of shares to take advantage of the stock pump. Absolutely remarkable. Of course, in January, they were also selling at lower prices of $71 before the acceleration in share prices took place. They sold on the way down in 2015. A lot of sales were done in July. So think about this. To sum up, Target CEOs sold 15.5% of their holdings. That's a huge amount of selling, 116,000 shares, in fact, and they bought back $3 billion worth of stock in the first 3 months to help boost the share up. Well, that's crazy. And they did this ahead of today's horrible news and horrible stock dump. And who's left holding the bag? Not the insiders, the long-term investor who thinks that Target is some great company. I do think it's a nice store that has nothing to do with share prices. And one reason why that's the case is because Target stock has a price to book of 3.42, PE today of 12. It was higher, of course, yesterday. Negative revenue growth. It just simply doesn't have great fundamentals. So here's the thing. What's going on with Target is going on with many stocks in the U.S. stock market. This type of insider dumping and stock share buybacks is widespread throughout the entire stock market. This is just one stock out of hundreds and hundreds of stocks, if not 1,000 stocks, that have been doing this. Dunkin' Donuts is one that's had massive insider selling and is also buyback. Sad story. The real sad story is where you get stocks that have blown their balance sheets and gone into debt in order to engage in these buybacks. Target really isn't that terrible of a story in that case, but a stock such as Dunkin' Donuts is a total nightmare story because Dunkin' Donuts has issued huge amounts of junk bonds to engage in their share buybacks over the past couple of years. Long-term debt for Dunkin' Donuts was $1.8 billion. Now it's $2.4 billion. So there's companies such as Dunkin' Donuts that are borrowed money, gone into debt to do share buybacks like the insiders have dumped. They don't care about the long-term outlook, the future. All they care about is what they're doing now. Not much different from what so many of the Wall Street banks did in 2007 ahead of the 2008 collapse. So this is where we are in the stock market. CNBC won't tell you about these type of things. They won't go into details. Yes, they have to talk about Target today because it is a disaster, but I doubt they're going to go into detail like we're doing with these balance sheets and what's going on with stock buybacks. Because stock buybacks, frankly, is a scandal for what some companies are doing. So for more information from me, if you're not on my free email list, you're just watching this randomly on the internet, go to wallstreetwindow.com and get on the free email list, get more updates, and so forth, and we'll navigate these markets together.